Hi, I'm Tom Lydon, editor of ETF Trends, here in Washington, D.C. at the Schwab Impact Conference. I'm here with Dave Mazza, VP of ETF Investment Strategies at State Street Global Advisors. Dave, great being with you.
Tom, thanks for having me here.
Yeah, appreciate it. Listen, State Street is doing some innovative things in the ETF world, and I understand recently just launched a few new active ETFs.
That's correct. So we launched our first active ETFs over a year ago, and then we recently launched an active senior loan product, SRLN, in conjunction with GSO Blackstone.
So the senior loan product, talk a little bit about the strategy, especially today, as you know, fixed income is under a little bit of a rate threat, right?
Correct.
Where you see that headwind that's coming. What you folks have done in listening to the advisor market, said, hey, listen, we may be able to carve out an alternative to treasuries and also get that yield as well, right?
Yeah, so what we wanted to do with SRLN was combine the best of both worlds.
Right.
The best that active management can bring to senior secured loans, which is a very unique asset class, and the benefits of an ETF, cost efficiency, liquidity, and tax efficiency. Package those together, bring that active management that advisors have come to expect and really embrace within very inefficient asset class with the benefits of an ETF in one ticker.
So give us an example. How are advisors using that product?
Yeah, so some of the ways advisors are using that is carving out portions of their fixed income allocation to say, I want a strategy which is going to be more resilient to a rising rate environment. I want one that's going to respond to changes in interest rates as we sort of are at the end of a 30-year bull run in fixed income, and senior loans are an excellent way of addressing that.
So where are the biggest risks? Is it treasuries? Would you say the average advisor might be paring down their treasury allocation and shifting a little bit more into senior loans, into corporates?
Yeah, we continue to see advisors look to shift their strategies away from the treasury market because of all of the risks that are inherent today that really were never there for the past 30 years. Here we are with rates extremely low, would have the potential to bring a lot of volatility to what used to be a core part of portfolios. So what we're seeing advisors do is move into senior secured loans, move into short-term high yield and other solutions on the corporate side to help get current yield in portfolios and address the potential for interest rate risk down the road.
So talk about the liquidity aspect, because as you said, this is kind of a slight, really tight niche of the fixed income space. Is there enough liquidity there?
There really is. The senior secured loan market has matured a lot over the last few years, and the ability that ETFs, who are now part of the market, bring additional liquidity as different types of investors, not just advisors, but institutions, look towards ETFs to help bring them the liquidity they need in an otherwise very opaque and illiquid asset class like loans.
Yeah. So you have some pure beta fixed income products that have really been core positions for advisors for many, many years. Any thoughts as we talk more about active? Are advisors becoming a little bit more tactical with this headwind or the light coming down the tracks?
Yeah, Tom, I think what we've seen is the pendulum has swung very far in the direction of passive management.
Yeah.
And it's interesting to see here we are, 5 years of recovery in the US and global economic picture, and we are beginning to see advisors be a little bit more comfortable introducing active management in portfolios. Because active ETFs, as you know, are only 1% of the market. There's a lot of products out there that haven't really been embraced until recently. So what I expect to see going forward is that advisors will continue to add active management in places like loans, and maybe even in the holy grail, active equity management, where we can pair that traditional active management with the benefits of an ETF.
Do you think if we're sitting here a year from now, we're going to see a lot more active product in the pipeline?
Tom, it's going to be difficult to say exactly how many active ETFs are launched. We know there's a lot in filing, but I do expect that over the next year, we're really going to continue to see an increased trend and really acceptance by advisors to say, this is a product that I can not just own tactically, but strategically fit a lot of needs in a portfolio, just like traditional funds and all those great beta ETFs have always done.
Yeah, absolutely. Well, I know you folks were the innovators. You started the first ETF over 20 years ago, SPY, and you continue to be one of the top producers out there just because of this innovation. So congratulations, and it's great spending some time with you, Dave.
Thanks, Tom. It was great to have the chance to chat with you today.
Yeah, thank you.